It's no secret that the gift and estate tax exclusion may go down in the near future. However, a reduction to those exclusions will also result in a reduction of the GST tax exemption, which could be wasted if not used now. For surviving spouses who are beneficiaries of marital trusts, the assets of these trusts may be a great source of assets to gift for purposes of using this GST tax exemption before it goes away. There's an added benefit of being able to apply any deceased spousal unused exclusion or DSUE to these assets as well. Now, if you're going to use a marital trust for GST tax planning, there are some pitfalls and cons to be aware of. One is considering the effect of a non-qualified disclaimer under the trust document itself. Would it send assets to a credit shelter trust, which could be includable in the spouse's gross estate due to a gift? Another thing to think of is, are principal distributions permitted if you're going to use outright distributed assets to make the gift, especially if those assets will be in excess of any ascertainable standard? And finally, if assets are distributed from a GST exempt marital trust that has a reverse Q-tip election in place, does this GST tax exempt status remain with the gifted assets once they are out of fiduciary control? I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 200, we're going to look at GST tax planning with gifts from marital trusts. First off, I've reached this milestone of episode 200, so for those of you listening and who have listened in the past, I'd like to thank you for your patronage and for listening to me, and I promise to keep bringing you content like this in the future as well. Back to our material, I want to remind you as always that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. So, for marital trusts, if there's either a Q-tip election that's made or a general power of appointment that's granted to the spouse, what that means is that the spouse will be treated as the transfer tax owner of the trust assets. Now that's obvious for estate tax purposes, because either Code Sections 2041 or 2044 will include those assets in the spouse's gross estate, but there is no estate tax at first death due to the marital deduction. However, since the spouse is the transfer tax owner at death, it stands to reason too that if there is a release of an interest in the trust during life, this would also be a taxable gift. Now, a marital trust is often not GST exempt due to the estate tax inclusion period rules, or ETIP rules, which prevent application of GST exemption until second death. However, as discussed in prior episodes, you can make a reverse Q-tip election for marital trusts that are eligible for and with respect to which an actual estate or gift tax Q-tip election has been made. The benefit is that the GST exemption of the first spouse to die, or the donor spouse, can be applied to that marital trust to create a GST exempt trust. Either way, you can either have a GST non-exempt marital trust or a GST exempt marital trust. That being said, gifting in order to use up to $8.2 million in gift or estate tax exclusion that might go away has been the common strategy of late, but there hasn't been a lot of attention given to the loss potentially of the GST tax exemption, which can really disproportionately affect marital trusts here. Not only that, there's a potential legislative change which could limit the term of GST exemption for all GST exempt or grandfathered trusts to a period not to exceed 50 years. So, in situations where you have a surviving spouse for whom a marital trust has been created, and as long as there's enough assets available to allow that surviving spouse to maintain their standard of living, then those marital trust assets could serve as a great source for gifted assets and could leverage tax planning as well, especially for the GST tax exemption or unused exclusion of a deceased spouse through a portability election. We're not going to talk about the portability election as much today, but I want to focus specifically on the GST non-exempt marital trust, followed by the GST exempt marital trust. So, in a case where you have a non-exempt marital trust, i.e. one that has a general power of appointment granted to the spouse or no reverse Q-tip election, There's no GST exemption that was allocated to this trust previously, but at the surviving spouse's death, they'll have to apply their own GST tax exemption to it, which may go down. So it may be a good idea right now, while the GST tax exemption is higher, to use up that exemption by making gifts of the marital trust assets. Now, since these assets will be included in the surviving spouse's gross estate, any transfer of these assets to any sort of remainder beneficiary will be treated as a taxable gift. So the pro here is that use of non-exempt marital trust assets to make a gift is a great way and a tax-efficient way to use the spouse's GST exemption, gift tax exclusion, and any deceased spousal unused exclusion. There are some cons, however. One, you need to dig into the trust instrument because usually the method of gifting here is going to involve either a non-qualified disclaimer or a distribution. So we're going to look just at the non-qualified disclaimer first because the terms of the trust often have disclaimer language which may send these assets not to skip persons or non-skip persons but instead to a credit shelter trust which benefit those persons plus the spouse. So, since the spouse is usually a beneficiary of that credit shelter trust where assets flow after the non-qualified disclaimer, this will be a gift to the credit shelter trust, which will cause that part of the credit shelter trust to be included in the spouse's gross estate due to their retained beneficial interest. If that were to happen, that wastes both the GST exemption and the gift tax exclusion, although the gift tax exclusion that's been used could result in a higher applicable credit against estate tax, but with the appreciation in assets post-gift being pulled back into the gross estate. Now, with that being said, you may have to look at a double disclaimer to get around this issue where you disclaim both the marital trust interest and the credit shelter trust interest. It's not a good idea if there's a need for economic access to the assets to just disclaim to the credit shelter trust, as I mentioned. Now, the big question is whether that double disclaimer could result in a double gift because both disclaimers would be non-qualified disclaimers. So the IRS could try to argue that, but I think this is also a ripe argument to argue step transaction against the IRS, which is the opposite of what usually happens. Really what you'd have to do is just look at two steps, two non-qualified disclaimers that really reach an end result. So if the IRS tries to double dip on taxes there, they'd really be trying to use the argument that they tend to fight taxpayers on with that step transaction type of approach. But if you want to avoid that non-qualified disclaimer issue, you could also consider having the trustee distribute principal from the non-exempt marital trust to the spouse. The spouse could turn around and gift those distributed assets. So the pro here is that as long as this is a gift to or for the benefit of skip persons, this would use the spouse's GST tax exemption as well as the gift tax exclusion and a DSUE amount as well. But the con is that this may be prohibited or limited under the trust document itself. First, you have to see if the spouse can even receive principal distributions from the non-exempt marital trust. If they can, those principal distributions may be limited to an ascertainable standard. So the question is, how does that standard align with the intent of the settlor of the trust? So for example, if tax savings is a goal, could that give the trustee the authority to exceed HEMS with respect to the spouse, as long as maybe the gifts to descendants might respect that HEMS standard as well by being distributed in further trust for their benefit. Also, you need to consider that the gift would need to go to the remainder beneficiaries of the trust in order to avoid a breach of fiduciary duty, especially with respect to any principal that exceeds a HEMS standard when distributed to the spouse. So how can the trustee enforce this? It may be difficult under state or local law to have a conditional gift, although gift tax doesn't really get into conditions like that. You'd need to have a way for the trustee and the spouse to have some sort of contract to guarantee that the assets would be gifted in the way that the settlor intended under the trust document itself. Now, it could be the case that you have a GST exempt marital trust, and in some ways this may be a better candidate for gifting because by gifting, you use the spouse's gift tax exclusion and DSUE, but you may not use the spouse's GST tax exemption because those trust assets are already exempt from the GST tax. So, With that being said, there are some cons here. We have the same issues that pop up with non-qualified disclaimers and of distributions to the spouse. Now, there's an added layer here in that this is a very inefficient type of transfer that wastes GST exemption potentially if those assets are gifted to non-skip persons. So overall, that gifting strategy may have to follow the remainder beneficiary patterns under the trust. It may be inefficient if you can't just focus these gifts to skip persons, since the assets are already GST tax exempt. And it stands to reason here too that we have to look at the method of gift here. So obviously with a qualified disclaimer, you're disclaiming exempt assets, so there'd be no GST tax due to the reverse Q-tip election. But would this GST exempt status through the reverse Q-tip election also attach to distributed assets if the spouse makes a gift? It stands to reason that the IRS could argue no, but you'd have to look at the fact that since the spouse would have been subject anyway to estate or gift taxes on those assets, you could make that argument and maybe look to a step transaction approach as well, that the end result is the same regardless of whether there was a non-qualified disclaimer or a release or an exercise of a power of appointment or just an outright distribution followed by a gift from the spouse. So lots of permutations there, but either way, if you have a client who's a surviving spouse and who is the beneficiary of a marital trust, there could be great opportunities not only for gift tax planning, but also for GST tax planning through those trust assets. As always, if you have non-client related questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.